Welcome to the Rose Show podcast. Hello, and welcome to the Rose Show. The following podcast was recorded via Twitter Spaces. Thank you for listening. Welcome to post-CPI analysis, macro, markets, and more with Michael Kramer of Mott Capital and soon to be joined by Aahan of Prometheus Research. Some of my favorites. Not only brilliant, but super nice people, and that's very important. So thank you to all the listeners for joining us this afternoon. We hope to make this space educational and lots of fun. Quick disclaimer, please do not construe this as investment or financial advice. I'm Rosanna, your host, and I'm here with the famous, now we can say the famous Michael Kramer. And it's a big day for you. So, and we already discussed your Fox Business, and you guys can all watch Fox Business on Charles Payne's site. He was on at 2:15 today.
Yeah, the video.
So make sure you watch that clip.
I posted a video clip as well.
Me too. I also posted it. And on his site, it has Michael Kramer. If the stock market jumps ahead of itself, Federal Reserve's job gets harder. I think he's quoting you.
Yeah, and that's basically been what the story has been since the beginning of the year, and
exactly,
and nothing has changed. So I think that that kind of segues into the CPI report today, right?
Exactly, absolutely, and we'll definitely be speaking about that. And that's exactly what this space is about: the CPI report, the Fed, macro, the market's reaction, and what it means for the market going forward. So let's begin. So I'll start right away with the CPI September report. Michael, you and I both anticipated higher.
Yep.
And we got it. Because we turned, we turned to Cleveland Fed always.
Exactly.
Exactly. And I love what you say, and I quoted you since then. Cleveland Fed has been forecasting just under the actual 17 out of the past 19 times. And
make it 18
and you know
20.
what that today made it?
18 for 20.
Yes, that's what I just, exactly. And make it 18 for 20 now.
Right.
So we're at 90% accuracy.
That's amazing.
So I turned to Cleveland Fed. Amazing, right? I turn to them for
all you got to do is listen to
time.
Loretta Mester and see what she's telling you about inflation, because she knows.
She does. Exactly. So let's look at the CPI. Now, I look at month over month, as I know you do. That's the focus. Right. So we look at Cleveland Fed, 0.32%. Actual, 0.4%. Right. Check. Core, month over month forecast by Cleveland Fed, 0.51%. Actual, 0.6%. Now, that's some pretty accurate forecasting right there. Yep. So, Michael, what do you think about the readings today? Are you surprised in any way? Did you expect higher? Are these in line with what you thought?
I think,
give us your thoughts.
I think these were pretty much what I was expecting. Like I was looking for something to be a little bit slightly, at the Cleveland Fed number or slightly higher, and I think that's pretty much what we got. And I think these numbers tell us that the Fed's job is very far from being over.
Exactly.
And,
I agree.
The bond market certainly illustrated that today with movements in Fed fund futures and 2-year notes and 10 years.
Yes, and we're getting to that. Yep, we're getting to all that for sure. I loved your chart about the Fed funds rate. We're going to get to that. So let's go through the CPI report. It has some sticky components that we saw in August that are still present. Services, shelter, rents are still going higher in most parts, I think almost all over the country. I mean, definitely in New York. And the OER is calculated only 2 times per year. So that's a very slow process, right. Very sticky. Shelter, I think, is data lagging, 5 quarters plus.
Right.
Then we have food we have significant food inflation, transportation, and medical. Doesn't seem like it's coming down just yet. What do you think?
No, it certainly doesn't seem that way. And, the other thing too is, I hate to say it, but what has the price of oil done over the last couple of weeks, right? What is the price of gasoline done over the last couple of weeks. So it may very well be the case that we have not only inflation that's sticky right now, but if you start seeing what energy costs are going to start going up, especially as we go into the winter, it's possible that these inflation numbers could actually still go higher.
Exactly. I love your thinking. I agree. Now we look forward to October CPI. And of course, we go right to Cleveland Fed's site and we see that now they're forecasting the CPI month over month 0.8% and the core 0.53%. So as you said, it's higher.
And then when you look at year over year, 8.1% for headline, and
yes.
it's almost 6.6% again for core.
Yes, exactly. So we're about at the same. We're 8 point, and they come just under. So you could easily say we could be about the same as this month,
8.2,
year
yeah,
over year.
8.2, yeah.
Yes, the same reading. Yeah, and then we could have the core CPI very similar
6.6
year over year that we got this month.
That's right.
Yes.
Yep.
So that's very, very concerning.
And the other thing that's that we the other thing that I was going to say is Atlanta Fed sticky 12-month CPI today, up to 6.5, the highest in the series this cycle.
Wow.
So that is not showing, and this is this type of inflation that the Fed cares, the most about, right? And that's the highest value. You have to go all the way back to the year 1982. So,
wow.
we're
Interesting fact. You love
we're at
that.
40-year highs in sticky inflation. And this is why, like, when we think about where rates are going, you can't, you got to still be of the mindset that rates can still go significantly higher from here.
Exactly. I agree. And I love that you mentioned that important information in addition to Cleveland Fed. So that puts things into light for us all. We need to be aware of what's going on. Now, you mentioned the rates, and now very important. The first thing I did after I read the CPI report was go to the Fed Watch tool.
Right.
Because I want to know the effects of the CPI on the Fed meeting in November and December. After the report today, we saw for November, the probability of a 75 basis points for November went from significantly like 80%, 84% to 96.6%.
Right.
So it looks like we're going to have 75 basis points come November 2nd. We're currently at 300 to 325 basis points. It's now estimating 375 to 400. Then when we look at December, and I'm pulling it up right here, we see 66% chance of a 450 to 475 basis points, which means another 75 basis points. A total of 150 basis points. Michael, I have to give you total credit. Last time we met, from after that we did the post-Fed meeting space, you said you could see 125 to 150 points. And at the time, this Fed Watch tool was only saying, I think, about 100. Right. So you called it. It went up now to 150 basis points. What do you think now the Fed may do at the next two meetings? Do you think 150 basis points may be it?
Yeah, I mean, I think you're going to get 75 in November, and I think you're going to get 75 in December. And I'll tell you, if you don't start seeing unemployment rate rising and you don't start seeing inflation coming down, these rate hikes are going to continue well into 2023.
So how high do you see the Fed terminal rate going into next year if we don't see the labor market softening?
I mean, well, if you think about it this way, right? Where's your sort of, I mean, the Fed's kind of told us where they want rates to be. They are telling us they want real rates to all be positive across the curve. And, there's a lot of definitions in terms of real rates. It used to be, the inflation, the yield on the treasury minus the inflation rate. You have market-based, expectations for real rates. So, market-based expectations are all positive based on break evens. But if you were just take the, traditional definition of a positive real yield, um, that would imply that you would need to get, either inflation to start coming down to the 10-year, or the 10-year needs to start rising to the inflation rate. And so, I hope that there's some sort of middle ground where we can get, you know, uh, even if it's on a core PCE number, a 4.5, 5% number for core PCE, it sort of implies like a 5% sort of federal funds rate. And that probably also means
Yes.
higher rates on the back of the curve too. So I think that's where we're sort of looking at. And, if I think a 5% number is very possible here.
That's what I'm thinking as well. Yeah, I mean, as Powell said, there's 3 lessons that he learned from the high inflation of the 70s and 80s. It's their responsibility to deliver, low inflation. And they also want to avoid entrenchment. And that's a big one. We need to avoid entrenchment, which affects price settings and wage settings.
Right.
And it's their job to keep it at it until it's done. And now at the last meeting, and we did discuss this at the last space, was the 3 goals that Powell said that they are looking to see occur. 1, below trend growth.
Haven't
Yes,
had
I
that
think
yet.
we have that.
I don't know about,
We haven't,
I
no.
don't think we have. No.
It looks like, do you think it looks like we're headed that way, correct?
No. I think we're going the opposite
Really?
way. Well, I mean, think about it this way,
Wow.
right? Where's Atlanta Fed right now? Atlanta Fed GDP now
Well,
is at 2.9%. The next reading comes tomorrow. So 2.9% real GDP growth rate. Cleveland Fed's estimating, an inflation, I think for the third quarter was around 6%. So if you have a price index at 6, 7%, and you have real GDP of 2.9, that sort of implies like a 9 to 10% real nominal growth rate, which is higher than where it was in the second quarter.
yeah, that is true.
So I don't.
Yeah, it was looking, yeah, I guess it doesn't look like that on paper then, even though we all can feel that we're experiencing a lower growth and a below trend growth. I guess the numbers like that show us
I mean, that
otherwise.
could be, again, I'm trying to estimate and think about it, but that's what, that's what CP, the price index tends to run, the GDP price index, GDP deflator tends to run, sort of in line with CPI. And again, looking at the Cleveland Fed's number, they're calling for about a 6%, quarterly CPI. We know that's probably too low because we had 3 quarters in a row of higher than 8%. But again, on an annualized basis, 6% plus 2.9% in real GDP is almost 9%.
Yes. Now, Aahan from Prometheus, founder of Prometheus Research, is going to be joining us soon. And according to his latest real GDP nowcast, he placed the economic growth at 0.8% versus 1 year ago. So he spoke about the change.
Right.
And
That's the year over year.
yeah, so yes, exactly. So he's showing real GDP moving into a negative territory over the next 6 months.
Well,
So when I read
we'd
that,
have to ask him,
yeah,
because if it's 0.8% year over year,
exactly.
what is it on an annualized basis, right?
Exactly. And that's what I'm looking forward to ask. Oh, there he is. He's here. Wonderful. He knew. Okay, here he is. I'm inviting him to speak. Perfect. Your ears must have been buzzing and you came. This is wonderful. We're speaking of your wonderful Prometheus Research, the observatory.
Hey guys, how's it going?
So let's see. Great. Aahan, thank you so much for
Yeah, of course.
coming.
Sorry I'm late. Very nice to be here.
Welcome. You're the founder of Prometheus Research, an amazing macro research company business. We're just talking about GDP,
Hey,
and I was
Rosanna, you cut
referencing
out for a
your.
second.
Oh, okay. Oh, I'm sorry. I was saying, I don't know how far. Can you hear me now?
Let me. It's probably my.
Can anyone else? Okay. Can anyone else hear me?
I hear you.
Okay, wonderful. So Aahan might have bad connection where he's located. This happened in our last
I
space.
think this should be better, yeah?
Okay, wonderful. Great. Can you hear me now?
Is this any better?
Yes, I hear you. Oh. Hello? Are you there, Aahan? Can anyone else hear me?
I hear you.
Okay, wonderful. I think Aahan is having connection issues. So let's just continue with what we were saying. So we will ask him about the GDP moving into negative territory, which he speaks about extensively in his report.
Okay.
Yeah, I see, there he is. Let me see if his connection is better now. I'm sorry, everyone. Let's see if this works. Okay. Well, you know what? We'll go with our number 2. Oh, hey, there you are.
Yeah.
Okay, perfect. Can you hear us
sorry
now?
about that.
You're there? That's okay. Aahan, I was just speaking about your amazing macro Prometheus Research. You're the founder of Prometheus Research. And we thank you so much for joining us today. And you came at the perfect time, right when we were discussing GDP growth. And I referenced your recent study on real GDP growth, how you say it places economic growth at 0.8% versus 1 year ago. And that future growth shows real GDP moving into negative territory over the next 6 months. Could you please explain that for us?
Yeah, so thanks again for having me. What we're tracking, so we have a GDP nowcast, and we typically we focus on year-over-year numbers. What we're expecting is we have a couple of proprietary gauges that allow us to get a sense of kind of how the capital cycle is moving. So we basically look at contemporaneously what's happening with real profitability, the cost of capital, and kind of future expectations. Combination of things gives us like a rough estimate of where GDP will be over the next, call it, 3 to 6 months. And based on that kind of rough netting out, which we can talk more about kind of the views underlying that, but we place GDP over the next 6 months on a year-over-year basis somewhere between -1% and -2%.
What does that I'm sorry. So what does that come out to in terms of an annualized number? Like if we were to do a seasonally annually adjusted rate?
That is a seasonally adjusted annual rate, right? Year-over-year numbers are.
Okay.
So unless you're talking about a quarterly rate, we typically don't focus on the quarterly rates. Just
right. Well,
I'm
sorry. That's what I meant. So like, like right now we were talking about GDP now from Atlanta Fed estimating a 2.9% annualized real rate. And then I was
but you do tend to have a lot of intra-quarter kind of variation even with GDP now. So you don't really know, and also it just depends on how you weight things when it comes to GDP now. So I think there's been a lot of like focus on how GDP now is really up a lot, but a lot of it has just come on the back of like ISM data and export data and stuff like that. And as you kind of progress through, this quarter, the next one, you probably have kind of a trend lower. I always tend to focus much more on the year-over-year numbers because it just gives you kind of a smoother path in terms of what you're expecting.
Sure.
But yeah. Oh,
yes. Well, then that was what we were talking about in terms of, whether or not we were achieving one of the Fed's goals, which was to see below trend growth. And, if you have basically the last 2 quarters, we've seen, very strong nominal growth. And when you factor in sort of a real GDP now model, of about 2.9%, and let's call it a 6% or 7% price deflator, we're talking about potentially a 9 to 10% sort of nominal growth rate, which would sort of imply that the economy may have accelerated in the third quarter.
Right. And I think that this is kind of like a sign of the times, right? Like you have extremely strong nominal activity, and that kind of confuses things too, because there's a good deal of argument about whether like so one of the inputs that kind of is driving up nominal activity, especially in these GDP Now reports, are things like PMIs. Now PMIs, the surveys actually don't really if you go and look at like say regional surveys, they don't actually differentiate between nominal and real activity, so it's one of those things that can kind of create a more mixed picture in what is being printed in these PMIs, in these GDP Now reports. What I will say is that what I think this does, right? So even if you have GDP Now up, like you're saying, it basically just takes us further away from the Fed's, stated objectives, right? Their objective is to tame nominal activity using interest rates and QT to achieve an inflation outcome. And I think that the combination of these things just means that the Fed has to go further than most people are discounting right now.
Correct. And that I agree with you on. I think that we're finding out that the neutral rate that the Fed has thought is neutral and that 2.5 to 3% level is too low, and that the real
Right.
neutral rate is much higher, probably 5%.
Right. So I think that, history is a good kind of guide for this, right? What we've needed in the past to, in air quotes, break the back of inflation is real rates. So if we call real rates like, relative to CPI, you've needed real rates positive, and you've needed them positive about 2%. And the reason that kind of works is because, by the time you actually reach this point where inflation is, air quotes again, breaking, real growth is kind of already disappeared, so your nominal chunk is almost completely made up of inflation.
Correct.
So you need your rates in excess of your nominal growth to cause this future contraction. What we have inflation trend at, so in terms of if and when it does decelerate, we have inflation trend at about 6.5%, right? And if you expect inflation trend to be worse, say you call it 4, you call it 5, you still need Fed funds way higher than we currently have.
Correct.
And I think that that's one of the things that's just underappreciated, because this thing has been consistent since the start of the year. Because if you look at people's experience, they've only experienced like a disinflationary real growth environment over the last 40 years, right? Like they're
Right.
just used to saying, oh yeah, we can only do so many hikes. The economy will break, this will break, that will break.
Correct.
So we started with they're one and done, right? And then it became 2 and done.
Right.
And now I think the situation is very
and the
much
multi times we're going to pivot.
Exactly. And I think that today's print, if we you would like to talk a little bit about today's print, I think that today's print just kind of, anybody that's kind of thinking about a pivot should really table that thought for a long while.
Yeah, they need to quit.
Agree. Yes, exactly. Absolutely.
Yeah, I agree like 100% with what you're saying. A lot of my work and research has also pointed to the fact that really what kind of drove inflation down in the 1970s and 80s was ultimately, the 2-year, 10-year getting above the rate of inflation and it's staying there for a prolonged period of time. And that the only time the Fed really cut rates was when inflation went down. And so, when you think about what that means, I mean, and it's kind of scary to say that, right? But I mean, if we have an 8% CPI, that almost implies a 10%, 10-year rate. And nobody wants to think about that because that would be complete, havoc and chaos. The financial system probably couldn't handle that type of rate. And that it's almost scary to even talk about it. And to think that may actually, if inflation doesn't start to come down, that's the type of thing we maybe have to consider. That's going to be a big problem.
Yeah, and I think that this is the thing, right? That I think you've highlighted the exact right problem that we're facing. The Fed only has essentially two tools, right? They have rates and they have QT, which, let's say for argument's sake, that's another 100 basis points. You still have, if we stay at 6%, that means terminal Fed funds at 7, right?
Yeah.
Which is still
maybe 8.
extremely high. maybe 8. Yeah, and that's what they need to do, because what we did, right, where the Fed is trying to reverse what both the Fed and Treasury did together.
Correct.
And so the Treasury and Fed came together and created, the Fed can create financial liquidity, the Treasury can create real economic liquidity, and now the Fed can reverse financial liquidity, but they can't do anything about real economic liquidity. So they're trying to fight this battle by basically, so demand in the economy is just a function of the amount of money out there plus the amount of credit created, right? They're trying to cause a contraction in total activity by making it happen all through the credit channel, and that's a really tall order, right?
While
So
while
I
the,
think that
the government runs a deficit.
exactly. So I think that, and the way things are going, it looks quite possible that they go UK style and may start actually doing more deficit spending. So you have these kind of the easy solution, and not necessarily the politically palatable solution, would be to increase taxes massively right now, right? That would be the
Boo.
countercyclical
Boo. We
force
don't
you
want
need to
that.
actually cause a contraction in nominal activity. But there's just no kind of there's no political appetite to do something like that. So I think that the thing that investors have to be really mindful of right now is that during periods of what we call tightening liquidity, where you have quantitative tightening and you have rising interest rates, almost no asset can survive, because every asset is discounted by cash, and cash rates are rising and liquidity is being pulled out of the system. So at least on the long side, it's not an environment to be saying, oh yeah, I'm going to wait to buy a dip um, on both bonds and stocks. And so we've done work in terms of, when it comes to treasuries, we've done a lot of work on the 70s and stuff like that, and we've backtested a lot of our systematic strategies through the 70s to get a sense of how they would do. The thing that's needed really to form a durable bid for bonds is that you need large floor to underwrite it, right? So you need basically a lot of buyers. The largest buyers during this the last time we had this, which was the interim period between the first peak in the late 70s and then 84, were depository institutions, commercial banks. They came in very large size because at that point you could pick up a lot of carry, right, which is what they like. But now, today, what we need to recreate those conditions is we need not a Fed to pause. We need a Fed to say that we're done and we're not going to do anymore and we beat inflation. And we're just so far from that point.
Yeah.
Agree. Absolutely. What a wonderful discussion. I love how you guys asked each other, you asked him questions and it was a discussion in itself. Thank you so much for explaining that. And I know you mentioned about the CPI report. I just want to back up. Michael and I discussed how the Cleveland Fed came in just under the actual that we saw today. And now looking at October, it looks to be even higher month over month. So exactly what you all both are saying seems to be right on. And then we look at the same sticky components that we've been seeing: services, shelter, rents are going up, and the OER is calculated 2 times a year. So that's a slow process. Food, transportation, medical. It doesn't seem like it's coming down just yet. But at the same time, we don't want to have, like you said, Michael, 10% rates. So at some point, something's got to give here, and this needs to start coming down because we can't go at that high. I mean, that's
and
alarming.
the biggest thing, Aahan was talking about the liquidity. I mean, the Fed is basically incentivizing everyone to put their money into money market accounts right now because they're getting, these reverse repos every day, 2.2, 2.3 trillion. So, there's just, it just seems to me like this, this cycle that we've created is very difficult for risk assets to do well in. Are you going to put your money in a money market account and earn 2 or 3%, or are you going to put it in the S&P 500 and lose 24? So and basically the Fed is coming along and saying, here guys, do it, put it in the money market account, put it in our reverse repo, because we're going to pay you 3% every day on an annualized basis. And the best part about this is that if you don't want to put that money back in tomorrow, you don't have to. And
Right. No, I,
and
I,
every
I
time they
totally
raise
agree.
rates another 75 basis points, that repo facility goes up another 75 basis points. So
Hmm.
it's a very difficult system for really any risk asset today. And you know, it's really this whole thing has just become a giant mess.
Exactly.
Right.
The
I
real
think that
return, I think, is
there are levels
negative.
of things that we need to think about. I think the first order of business is like very much recognizing this. Like you've laid this out well, that assets, until we're done, assets are a very tough buy across the spectrum, right? So even if you have commodity exposure now, it's much harder than it was at the start of the year to generate good performance in commodities, except maybe energies. But even that, who knows if they're legs, right? So I think the first order of business for most people is to be able to find good yielders on the short end, right? Like they need to be able to find things that make sense to kind of preserve their capital. I think that the next thing that really makes sense is to understand that this environment that we're creating, we can't do it for a really long time, right? Because the entire financial system is not built for extreme tightening in liquidity ad infinitum, because it's just not conducive to capital formation over long periods of time. So at some point you're going to have one of the many asset classes end up outperforming others and cash. So what you really need in this environment more than anything is diversification, and true diversification, right? You need diversification across strategies, you need diversification across asset classes. It's not a question of I own 10 stocks, I'm going to own 20, right? Like you need real diversification. And then I think the real thing is that this is an environment for people that are active strategies, like people that have active strategies. I think that the ability to effectively and efficiently be able to short things and be able to capture kind of asymmetries that exist in the market today, especially given kind of the dynamics that we're talking about. I think that that's kind of really important. So that's broad strokes how I think that we as investors really have to like deal with this problem.
Yeah, and
Thank you. I
yeah, go ahead.
love that.
Sorry, go ahead.
No, I'm sorry. I'm just saying I love that. And
Oh
when
no,
you
no, I was done.
mean, yeah, when you mean by a mix of different asset classes, you mean equities and credit, commodities, tips and gold, treasuries, and dollar, and different types of assets, not just different, like you mentioned, Aahan, different kinds of stocks. Like, oh, I'm going to buy some energy stocks and I'm going to mix it with some tech and I'm going to do this. So it's different asset classes is the allocation. And the real return on assets has been negative. And I know we discussed this recently, and that's very important for people to understand, is that there's a big difference between nominal and real. And the real return has been negative. And you have more of a return on shorting assets than going long and holding cash. And I believe, Aahan, you're long the dollar. Is that correct? Hello?
I don't hear
Is anyone
I
there?
don't hear him.
Sorry. Okay. Oh, he's having connection issues. Okay.
Yeah,
I see. Let's see.
I see he
Okay.
dropped off. Um,
Yeah, he dropped off. He has connection issues in his place. So we can go back to the softening of the labor market. And now we had a great discussion on below trend growth. And it appears that, we've discussed that. So Michael, do you think we are anywhere near what the Fed's goal is of below trend growth?
no.
No.
No,
So there goes the first one. The first one, we're not there.
no,
So the second one, softening labor market, we
definitely,
just saw unemployment drop down
definitely
to
not.
July at right 3.5%. When I read that non-farm payroll, I was like, we went the wrong way.
Definitely
So
not.
we're back to July, 3.5% unemployment. And then number three, clear evidence that inflation is going to 2%.
Definitely not.
I don't think that we are going there's any evidence that inflation's even coming down, let alone going to 2%.
Right. And
So
so then
there we go.
everyone sits here and scratches their head and said, well, why does the market go up then today? I mean, you know, the equity market probably isn't the best tool in the world to, help you gauge monetary policy. But the basically, when you look at the Fed futures, those all rose dramatically today. You're talking about Fed funds rates now approaching 4.8% by the time we get to
Yes.
April of next year. We talked about the potential for 150 basis points of rate hikes between now and the end of this year. Right now I'm seeing, a 4.92. I'm reading 4.92 is the peak terminal rate in April of 23. So the Fed fund futures are starting to
Yes.
price in the reality that we might be heading to 5%. And, that goes to the reason why we rallied today, right? Because this was just exactly, it reminded me exactly like a Fed day. When we get the Fed comes out with the announcement, and no matter what the Fed says, the market just rips higher. This was the same exact, implied volatility melt, implied volatility for short dated options all expiring today. I think on the S&P reached something like 80 or 90% at 8:30 in the morning, right as the news came out. And then we saw that just melt all day long. And so you're basically going to not see much more implied volatility melting starting tomorrow. And potentially there goes your rally, and dose of reality comes back, as early as tomorrow or Monday.
Yes. Yes, it seems like the big drop in the IV is what causes rally.
Right.
And
And the clue, I
yeah, that
guess,
was,
early
yeah,
the
exactly.
clue really early on was someone messaged me at like 8:45, and they're like, "Why is the VIX going down?" And I'm like, "I don't know." But that was the big clue at that exact moment in time, because if there were people buying puts, or if there was nervousness, the VIX would have been rising, right? So as soon as the VIX started going down,
Yes.
that was kind of the indication that, this isn't going to be this is going to somehow turn around at some point during the day.
I take it you don't play straddles during these events.
No, I don't really do much of anything. I really, I
Yeah.
don't trade like I used to anymore. I just, what happens is because I get so wrapped up in the work I'm doing and trying to provide for everyone, that I'm not focused on what the market is doing every minute, and it ends up costing me more than what it would have been not to have done anything.
Exactly. I love that. That's exactly correct. It's better to do nothing because it's about what it costs you.
Right.
And if it costs you losses and headaches, it's not really worth it.
Right,
I agree with
because you're
you.
not paying
I don't.
you're not paying attention, as much as you should be.
Exactly. So, I want to talk about the bond yields. I think it's very important we speak about that and what's going on in the bond market. The 10-year right now, the yield is at about 4% and at cycle high. And I heard you say today that you could see it going to 4.25 and 4.5.
Correct.
Now, that's going to have some significant effects on the equity risk premium, which raises the SPX yields, so valuations and price come down.
Right.
So could you explain all that and what's in store for SPX with all that occurring, please?
Well, I mean, like right now, for example, if we do it a different way, sometimes I crisscross between the dividend yield of the S&P and the earnings yield. But what I did today was I actually looked at the dividend yield of the S&P 500, the spread between the dividend yield and the 10-year rate. And when I did the work this morning, it was at 2.1%, right? That's how wide the spread was. The spread hasn't been that wide since like 2004. And when you go back and you start looking at, where multiples were trading at in 2004, when the spread was in that 2% range, you're talking 13 and 14 multiples on the S&P 500. So again, you're talking low 3000s on the index from here. Um, Assuming that the rate doesn't go higher and that the S&P 500 yield or dividend yield doesn't change, right? If the spread continues to widen, you're talking about even lower and lower multiples, right? So, I mean, at this point, I think the case is that as long as rates stay elevated and the more equities sort of fight the rising rate environment, the more overvalued stocks are actually getting, the more pain there will be in the end.
Exactly. Makes sense.
Yeah. So I
Now, Mm-hmm.
So when we look at it from that perspective, that's how I was kind of look. And again, from the equity risk premium sort of earning yields perspective, it's the same thing. And the other thing is that earnings really aren't coming down, and so that's sort of distorting things too, because everyone's expecting earnings to come down, but we need to remember that earnings are calculated and derived in nominal terms, not in real terms, and that's the other problem.
Exactly.
Right,
Yes, the
Rosanna,
big nominal versus real. Yes. Yes.
could I chime in here?
Please do. I was going to come to you next, actually, right after here. But yes, please tell us your thoughts regarding all of this and anything else you'd like to add. We love hearing everything you say.
Yeah, appreciate that. So I think that it just to kind of add on, right? Like in terms of equity EPS, right? Like as an equity investor, you want to be essentially in a position where you're rolling up the EPS curve. So like you want and you want future EPS to expected EPS to be higher and rising than relative to what it is today. Um, Today we're kind of in a situation where you're having the initial phases of re-rating of that kind of EPS trajectory, and I think that a lot of this goes to the way aggregate S&P 500 EPS is calculated. It's calculated on a bottom-up basis, right? So you have on the sell side, you have individuals who are focused on one company or one set of sectors, and they're all, they have 5-year projections for cash flows and things like that. And for whatever reason, these guys tend to be fairly macro insensitive. They might get, kind of top down growth and inflation numbers from somebody else in another department. But when it comes to actually forecasting EPS relative to what's happening in macro, it's just not really what they're the best at. So as a result, you always tend to have these situations where when cyclical conditions begin to decline, equity EPS actually remains resilient, right? Um, and that happens up until a point where coincident performance begins to drop off, and then they begin re-rating a lot lower. Now, even then, what you have to realize is most times you will not see aggregate EPS projected to just fall out, right? It's just not something that happens. But where you will see it actually happen is in market pricing. So the arguments can be made that while earnings expectations might not have come off, I think that buy side expectations of what's going to happen to earnings is probably weak. I think the second component is like a really good discussion, right? Yes, profits are accorded in nominal terms, and I think that does kind of ameliorate like their discounting, because at the end of the day they're earning variable cash flows. But I think that if we as investors want to be intelligent about future prospects, right, like we have to think about the fact that the purpose of profitability is to reduce your real cost of capital to create output in the future. So on a real basis, our profitability, while it's quoted in nominal terms, is more than likely in negative. So as a result, like the output you're going to generate on per unit of incremental dollars earned today is just going to be lower, which is going to create a difficult outcome for you tomorrow. So I think that the current earnings setup, both from an earnings expectations kind of angle, and also from a real profitability perspective, is just telling you the future earnings aren't going to be as good, in addition to what's happening with discount rates. So I think that relative to bonds, right, like bonds might catch like amelioration for whatever reason. Like I clearly, if you're listening to what I'm saying, I don't think anything really catches a breath here. But when it comes to bonds versus stocks, I think that the relative of stocks versus actually favors bonds over stocks, because stocks are going to have these two drivers going against them. They're going to have discount rates, and they're going to have profitability issues.
That's right.
Exactly. Exactly. And earnings are seriously under pressure with the rising rates. I mean, between diminished future valuations, slowed growth, and rise in the cost of capital. I mean, cost of debt for companies, and that's causing their margins to get compressed. So there's a margin compression going on as well. And I mean, I tend to call it a dilution of value, and basically meaning you're getting less for every dollar. For every input, you're getting less output,
but we should
and productivity's down.
But we should also be clear, though. I mean, you're talking about, so we're talking about further down the road when it comes to this quarter specifically. I have a feeling that we're probably likely to see that earnings were much better than people think they're going to be, based off of that sort of idea that this is we still have some pretty good nominal growth here.
Yeah, the stagflationary nominal growth that Aahan speaks about. Yes, I mean, earnings are a nominal. So
yeah, so we are
yeah,
seeing that in our tracking. Like we're seeing that kind of in production numbers and investment numbers. That's kind of, so I wouldn't disagree that the current quarter you would see, you know, decent earnings numbers. But what I will say is what you want to be watching for is you want to see sequential decelerations in the year-over-year numbers.
Correct.
And that's the trend that we're already on, right? So like we already started that, and if we continue that, we're basically getting more confirmation that okay, like this thing is for real. We already had 2 quarters of sequential decelerations. Now the question is, are we going to get another? And if we are, we have a very high degree of conviction that, you know, in the you know, the following quarters we're going to have a even a nominal kind of profit contraction.
Correct. I think you're right. I think that we're probably getting to the point where we're going to start seeing, you know, and that's going to really make the guidance for the fourth quarter and any sort of color we get for 2023 important, because I think I agree with what you're saying, that we're getting to that point in time where if the economy is actually rolling over, then we should begin to see that in future forecasts.
Yeah. So
exactly. And yeah, go on. Sorry.
No, please go ahead, Rosanna. Sorry.
Oh, no, I was just going to say that that's why this takes time, and there's data lags and there's all kinds of it's a time component, and this all takes time to work through. So we're going to be looking at Q4 and into 23 potential more challenges and more compression going on at that point. It may not be immediate, but these are all these factors that are going to be occurring over the next 6 to 12 months. So hopefully on a positive side, because I always like to bring some positivity to everything, if Q3 is better than expected, maybe we will get a rally or some type of upside, and maybe we go from 36, 3,700, maybe we can go up back over 4,000. I mean, hopefully, I'm just trying to be positive and see if there's any potential for some type of rally come the end of year into November, and maybe by the beginning of December, a Santa Claus rally or something. Just an idea.
Yeah, I think that I would like for that to happen for people just generally, but I just don't. It's not something we're positioning for. It's not something we're telling clients to position for. You know, it's just for us, it doesn't seem like something that's likely. I think that the thing that, you know, I'd like to get both of your takes on, and, you know, kind of think about is the next leg. So I think that we're fairly in consensus in terms of, okay, like there needs to be higher than expected, you know, Fed funds terminal, and that we're going to see more tightening, and that likely we're heading towards an environment of stagflation. Now, the thing is that, you know, when you have these dynamics that are ensuing of, you know, reduced profitability, definitely negative real profitability, at some point you reach that point that, you know, Michael, you also have seen in your research, where almost, well, more than 100% of nominal growth ends up being just inflation, right? So your real output is effectively negative. At that point, you do not need to, one, keep up production, which is, by the way, you know, running up to capacity constraints right now. And at the same time, you actually do not need to keep up employment as much, because your per unit increase in output is not as high. And I think at that point, we start to see what kind of Fed we really have. Because that's the point where you start to see the weakness in the labor market that they are trying to engineer. And I think that what is underappreciated about that point is that when we enter into real growth contractions, the speed of rises in unemployment rates and claims rates are 4 to 5 times the magnitude of other moves, like in the rest of the business cycle. The reason for that is because when you take an employee out of the workforce and you remove his income, you remove his spending, which is someone else's income, and you kind of have this vicious cycle created. And that could happen based off where we're at right now, with inflation still running at 6%. And I think that that is really the hard part. And also where money can be made or lost. Because we can have one or two things happen for the Fed. They can decide, okay, you know what, we're in a new world, we have a new inflation target. And it's not that they haven't done that before. They did that, right? Like they went from 2% to an average of 2% to transitory, so it's not out of scope for them to change their inflation target in the face of a world of pain. They've already contracted asset markets. Bond markets are down 25%. They're causing a world of pain in the financial economy. And when you start out the real economy also to start to show that pain, the question is, are they going to be able to, stay on this path that they've started on? And I think that you might actually have a period where they either claim false victory or change their target. They move the goalpost. And it's not that that's necessarily a view. I just think that the point that we're going to get to when we get into outright stagflation with tightening liquidity is a very difficult one for policymakers. And I think that is going to be a big uncertainty that most people aren't thinking about.
Right, but they've already,
Yeah.
to some degree made it clear that, they're not going to be so quick to just change their inflation target, right? So, I mean, that might be something that's, if we don't see an improvement in the next couple of years, I guess, right? I guess that's probably would be a longer term battle.
I think it's, yes, changing the structural inflation target is definitely a more tall order. So, agreed. But I think that what can happen is similar to what happened, in kind of like the Volcker period, right? Where even Volcker, even though he battled inflation so hard, there was a period of inflation abatement, at which point they actually end up cutting.
Right.
And I think that double kind of peaking of inflation, that's not discounted at all, right?
No, that's not even probably thought about.
Exactly. And I think that environment, first, what it does is it creates a barn bull market. But then eventually it will really lead to, so it's going to suck a whole bunch of people in. And then it actually leads to a commodity bull market once again. So I think that thinking through that outcome, because I think that, if like you and I are talking, it's fairly like established, I think, at least in our minds and, the people over here, that there's a pretty good probability that we're going to have to reprice a little bit more in Fed funds. So I think the next kind of step is, okay, where do we go from there? And that is kind of the next opportunity and the next risk that I'm kind of trying to think about.
Yeah, and I think that's the biggest sort of challenge right now that we're going to have to, continue to deal with, is trying to figure out where it is that Fed terminal rate is going to likely end up being.
Okay, perfect. Well, thank you so much for being here and coming, and we appreciate you always, all your contributions, all your work. And please, can you just briefly tell us a little bit about Prometheus Research, how people can subscribe, and what services you offer?
Yeah, absolutely. So we have two products essentially. So it's Prometheus Research. Our reason for being is to democratize, access to elite macro. So we do systematic macro, which is basically we take an algorithmic approach to macro investing. We construct, rules-based portfolios that people can track and use. We have two different services. One is a completely free retail, research note, which goes out every time our systems kind of turn over. That's available on Substack. So that's prometheusresearch.substack.com. You can check that out. Completely free, open to anyone. And then we have something called Prometheus Bespoke, which is, something which is a little bit more tailor-made for, institutional investors and individual investors who are looking to kind of, integrate our models into the way they're trading and investing. So those are the two things. That's kind of what we do. Yeah.
Thank you so much. Thank you so much for coming, and we appreciate you so much. Have a great evening.
You too, Rosanna, and always such a pleasure to talk to you. I'm sorry, I have to jump, but always a pleasure.
Okay, thank you.
Bye.
Bye-bye. Bye. And in continuation of Aahan's discussion, I did want to chime in and add that I agree, revenues are being held up by inflation. I've tweeted extensively about that. we're seeing an increase in prices, which is holding up revenues. At the same time, cost of goods sold and expenses are much higher, leading to margins getting compressed. We're noticing lower volume and output rather than the same or higher. So productivity is down overall. But as Michael and Aahan said, this is something that will take time to really demonstrate and to appear in all the earnings. I think hopefully we've underestimated how the earnings will be for quarter three, and hopefully they'll be much better than planned and we can get some type of rally. I'm always looking for some type of positive in this. But we do know our situation. We do see inflation is still flashing over 8% year over year, which is very high. So we need to utilize risk management is number one. And that is reducing position size is always top for reducing emotion and lowering your risk. And I always believe that you should never force trades, never feel you have to make something happen. And cash is an undervalued position. And I do maintain a decent cash position during this time. I am an options trader as well. And I've been utilizing selling premiums. Since we have a higher VIX, I do believe in selling premiums has been working well, either bull put spreads or bear put spreads, and selling covered calls on my long positions. Now, as the famous Charlie Munger once said, the best thing a human being can do is help another human being know more. So that is what we hope we accomplished here this evening. The whole point of this discussion was to speak about CPI and what occurred today and what the report meant, some bond yield issues and macro and the market's reaction and where we see the market going. As Michael discussed, PEs 14 to 15 seem reasonable, which means a SPX of about 3,200. I know we don't like hearing or thinking about that, but it's very important that we remain aware of the situation and the possibilities of what can occur. So learning and sharing together, we can elevate each other to be better in investing and in life. Maintain a growth and positive mindset and believe in yourself. And most of all, never give up. Thank you so much for joining us this evening. I thank you, all of you. We value you all. Thank you so much. And until next time, have a great night. Bye-bye.
Thank you for listening to the Rose Show podcast. Please visit RosannaPrestia.com for more episodes. See you soon.